Kudos to Hibiscus management. Today we're going to be talking about Hibiscus Petroleum's acquisition of TotalEnergies Brunei. And while Hibiscus isn't exactly economics, it does fall within business economics. And since I'm the author of Value Investing Substack, I do analyze business economics. Without further ado, let's talk about Hibiscus's acquisition of TotalEnergies Brunei. Now, if you look at this chart that I made a few days ago, you can see what the impact of the acquisition will look like on their oil production. Basically, the left chart shows their gas production, while the right chart shows their oil and condensate production, which is basically just their oil production. Meanwhile, the blue bars show what their existing production looks like, while the orange bars show what the incremental production will look like post-acquisition. We can see that this is mostly a gas acquisition. The yellow dots show that gas production is going to increase by 86% roughly, while oil production will only increase by about 2%. And this is based on the same denominated unit, which is BOE or barrel of oil equivalent. So don't worry about converting volumes between oil and gas. They're basically the same. These are approximate figures used, so it's just meant to give you a rough idea of how much the incremental oil and gas production will be. And by extension, how much the revenue will increase. Of course, revenues don't necessarily translate to profits. The good news is Hibiscus actually did provide a slide in one of their presentations where they showed that the incremental profit from the acquisition will amount to roughly 150 million ringgit. So if we want to be conservative, that's about 30 million US dollars. So how do we determine whether this incremental 30 million US dollars that they acquired will be worth it? Obviously, it's based on the valuation that they paid, right? And if we look at what the valuation and what the acquisition price of TotalEnergies Brunei was, it was roughly 245 million US dollars. Anecdotally, I heard that this was a steal because the wells that they acquired still had many years remaining. Obviously, I'm not an oil and gas specialist, so I wouldn't be able to confirm. But our job as financial analysts is to determine whether the valuation was worth it or not, and we can do that. So based on the profits of 30 million US dollars, or the acquisition price paid of 245 million US dollars, we get a day one or initial yield of roughly 12.2%. Right? 30 divide 245 equals to 12.2%. Now, management did say that they expect the IRR of this to be roughly 15%. And if you know what IRR means in real life, it's just R plus G, right? Where R is the 12.2% we said earlier, which is the initial yield on day one, and G is the growth of that yield over time. So IRR is just the average yield over the life of the asset. And for that to average 15% over the entire life of the asset, that implies that management intends to improve the starting yield from 12.2% today to roughly 18% by the end of the life of the asset. So that should average around an IRR of 15%. And quite frankly, I can see that happening. That's just roughly improving the profits by about 50% by the end of the life of the asset, which should be 20 to 30 years from now. That actually sounds very reasonable, correct? So just to put it in profit terms, that would imply increasing the profit of 150 million ringgit today by roughly 75 million ringgit, or half of that, to about 225 million ringgit by the end of the life of the asset in 20 to 30 years time. Now, how do they intend to do it? So management did indicate that they plan to generate most of this increased profit from cost improvements rather than revenue improvements. But the unique thing about this is that the standard measure of cost improvements here is OPEX per barrel, right? And so the denominator here also can include increased drilling or increased revenue. I don't think they are necessarily mutually exclusive. It can be both revenue increases and cost improvements. Now, we don't really need to go into the details of that. If you want, feel free to head over to some of my articles. They're a bit outdated, but the business of oil and gas hasn't changed since I wrote them 2 years ago, so they're still relevant. But all we need to know is that the OPEX per barrel is going to increase going forward. So if you go back to my earlier formula of improving the profit yield by 6% over the next 20 years, which is the useful life of the asset, and honestly, you would expect a roughly 2.4% CAGR improvement in OPEX per barrel. And quite frankly, that is a low bar to clear. So most of the accretion in value is going to come from them paying a low price for this. And it does seem that they did a good job there. So kudos to Hibiscus management. Now, since I'm the author of Value Investing Substack, I do want to link this a bit to value investing, because if you think about Hibiscus's business model has been so far, is to acquire low risk oil fields at low valuations. That's not all, but let me break this down first. So what does low risk oil fields mean? It just means a brownfield asset, something that's already producing, as opposed to greenfield assets, which is looking for new oil fields. So since they're just acquiring someone else's field, the expected production is very high probability and therefore low risk. And they acquire these oil fields at low valuations, which gives them the starting yield that they want, and then try and improve it by 50% over the next 20 to 30 years, which comes up to about 2.4% CAGR as I demonstrated earlier, which is a super low bar to clear, right? Most of the accretion in value comes from acquiring it at a good price right at the beginning. So this is basically value investing, right? This is how Buffett acquires his companies. So if you want to think about Hibiscus's management as the value investors of the Southeast Asia oil and gas industry, yeah, it fits the bill, right? And if you think about what the acquisition model looks like, they basically issue debt or equity at very reasonable cost of debt or equity to acquire very highly cash generative oil and gas assets, where they will use the cash flow generated to pay down either the debt or to buy back shares. So in the last Repsol acquisition, they issued a lot of shares, but they've basically bought back most of it by now at an acceptable or better return on equity spread. And in the same way this time, they did hint that they would not be using equity at all, which implies that they will pay down the debt over time using the cash generated from the asset. And they do this in a very conservative fashion, which means they move very slowly. They will make sure they pay back the debt before they entertain the next acquisition. And the unique thing about oil and gas sector is that economies of scale matter a lot here, which means that basically the rich gets richer. So how this looks like in the oil and gas industry in practical terms is that Hibiscus has to grow big to be able to acquire bigger assets. It can't leapfrog in size overnight to try and buy Shell or Petronas, right? It has to grow steadily before the banks or the investors will allow them to acquire a new asset at the next level of size. So you see, they're just growing slowly in size so that they can eat the next acquired asset. And you can see how it's a very stable type of growth where there's a very high visibility of what their end goal looks like in 30 years time. And quite frankly, this is just a value investing strategy that Warren Buffett prescribes. Warren Buffett has a saying that the best business to own is a wonderful business. And he describes a wonderful business as one which can reinvest large amounts of capital at high rates of return over long periods of time. Now, if you think about the unique setup of Hibiscus's business right now, basically they are an oil and gas producer in a very strategic part of the world, which is between the West and China. So putting politics aside, the fact is it's a great business, right? Because you're in the middle of these two and they need to compete for your attention. And Hibiscus's business model, as we described, is very safe, is very conservative, is very predictable, despite the oil and gas industry being very cyclical. So it's very cash flow generative. They issue debt or equity to acquire a new asset at a reasonable rate of return. Then they use the cash flows generated from the new asset to pay down that debt. So by the end of it, it's like buying a house. They grow bigger. And then because of the increased size, now they can go out and hunt for bigger fish to acquire. And they repeat the process and then they can grow bigger again. So this is just a value investing wonderful business strategy. If you've ever wondered what a small cap wonderful business looks like according to value investing, this is exactly what it would look like. If you want to find out more about how I arrive at this conclusion, you can go and have a look at some of my slightly outdated articles written in 2022 about my Hibiscus analysis. The models, you can download them, just update them for the latest production rates. The formulas will automatically calculate all the scenario analysis for you to figure out what the normalized P ratio looks like. So with that, that's my assessment of Hibiscus's acquisition of TotalEnergies Brunei. If you enjoy this kind of content, please like, follow and subscribe to this channel so that we can give you more such interesting content in the future. Hope to see you in the next episode.